Committee, Chair of its Life IFRS 17.
This meeting is being recorded.
Okay, I think we might need to start. I'm Chair of its Life IFRS 17 Working Group and your host for today's webinar. I'll start with some housekeeping. Please note that this webinar is being recorded, as you just heard, and we plan to post to the Society's website and to ActuView afterwards. The Q&A is also being recorded. Attendees can submit questions at any point throughout the meeting, and we will have time at the end for our presenters to respond. Questions can be submitted through the Q&A portal, which should appear at the bottom of everyone's screen, and they can be posted alongside your name or anonymously if preferred. For Society members looking to record CPD, once you've registered with your full name, you are considered to have signed in for the purposes of CPD. So our standard note here that the views expressed today are not those necessarily of the Society of Actuaries or of their employers. And this event is consistent with the Society's competency framework wheel, as seen here. Very briefly, our overall agenda is I'm giving a little brief introduction, followed by today's speakers going through the technical considerations, issues and insights across various areas. And then we'll touch on some broader considerations before we have some time at the end for Q&A. Our IFRS 17 working groups, life and non-life, are outlined here. We have a number of members. The working group has been in existence for 4 years now, and we've had a number of events. These are linked to here, so this is the 9th in the series of those events. We have updated the IFRS 17 webpage recently to include some more links that has the amended standard in there from before, TRG papers and so on, but also more recently the IFRS Interpretations Committee publications and some other documents that may be of interest. Just to give some general context before we go into the detail, at the top of this slide you can see a high-level timeline. On the far left we have the opening balance sheet for comparatives year-end 21. Moving along, we have the red circle showing where we are today in mid-September of 22. And then we have the effective date of 1 January 23 for IFRS 17 and of course 9. Prior to that, you might have input to group disclosures and looking to maybe that ESMA guidance that came out during the year. When we move to 23, apart from quarterly reporting, if you're an IFRS reporter for your local accounts, you may have to consider local FS disclosures under IAS 8. And then when we get to year-end 23, that's the first full set of annual financial statements under IFRS 17 and 9 for those insurance companies. And that may well be signed off where the green circle is on the far right-hand side in maybe March or April in 24. So that's just to set the scene, and we can see that there's not very much time left at this stage till 1 January. In terms of some recent developments, and we're not being exhaustive here, the IFRS Interpretations Committee issued a couple of recent documents that will be of interest. In June, they issued their final agenda decision on the submission of transfer of insurance coverage under a group of annuity contracts. So that's relevant to a number of life companies in the Irish market. And then just this week on the 13th, the committee agreed to finalise its agenda decision in relation to multi-currency groups of insurance contracts. And that's relevant to a lot of life and non-life companies and reinsurers selling cross-border into other territories with different currencies. Both of those have been issued. We might touch on those later. They do leave scope for further interpretation and challenges. So it's not locked down necessarily. In terms of EU endorsement, the EFRAG in May published its final letter on the Interpretations Committee 10th decision on the final phase of implementing IFRS 17, and that's linked to here. ESMA guidance came out back in May, and that's relevant to 22 interims and 22 financial statements. So that's worth a read in terms of qualitative and quantitative disclosure considerations. And lastly, just to mention one other thing for our companies that either have group operations in the UK or maybe have components in the UK, that the UK Endorsement Board announced in May that it has approved the adoption of the ISB's version of IFRS 17 for use by UK companies. So that's just a whistle-stop tour of some of recent developments. I won't go through the agenda detail here, but those are the areas we plan touching on as part of this presentation. Big health warning, we're not going to be exhaustive in the time available to us. These are example issues and insights only. The slides are going to be available hereafter for reference, so please avail of that. I'm delighted to have a broad range of speakers from our life and non-life working group today. 8 speakers, including myself here. So just let me mention them briefly. I'll leave this for reference. So we have Frank O'Regan from Deloitte, David McCurtain from Grant Thornton, Porrick Byrne from Monument Life Insurance, Andy Smith from EY, Maz Musher supporting Irish Life as an independent, Francis Fury from Finalise, and Andrew Kay from Millman, and myself from PwC. So with that, I'll hand over to Frank. Thank you.
Thanks, Niall. Hi, my name is Frank O'Regan. I work at the Deloitte Actuarial Practice. So as Niall mentioned, we wanted to draw out some brief thoughts from the working group on some of the potential items that companies may be working through as they get to grips with their opening balance sheet. It's not meant to be a comprehensive overview of the topics. We're to likely touch on a number of the items that cropped up during our discussions. So the next 2 slides, I'll step through thoughts on classifications and level of aggregation and reinsurance. So I suppose point 1 here, I guess, sort of relates to companies, I suppose, with products that maybe did not clearly fit into any of the specific categorizations. You know, companies may be kind of kicking the can down the road and need to finalize decisions, particularly where products qualify for IFRS 17 or should be treated under IFRS 9. And related to that, I suppose, a more general point, and again, one where things may have been put on the long finger during the IFRS 17 program is the need to clarify and document positions on what constitutes distinct and indistinct sort of investment components. Companies may have products where it's arguable, where the insurer has no risk of making a loss. I suppose it's important to note here that considering paragraph B18 of the standard, there's quite a high bar to demonstrate that the insurance risk isn't significant. So that's probably one to consider, sort of, if that's something that you're looking at. Companies might need to digest some key differences from the IFRS 4 classification. Like in theory, there's no real difference between the classifications for insurance and contracts between IFRS 4 and IFRS 17, but the restrictions on unbundling of contracts may lead to the situation where the contract classification needs to be changed. I suppose in practice, as companies are reviewing all the products in detail again, this may throw up some clerical errors that have occurred in the past, but it's probably more likely on smaller or less material products. Refocusing on the opening balance sheet theme, to note that if the fair value approach is being used, the need for annual cohorts falls away, and that profitability assessments are done sort of at the point of transition. And related then, and more generally, to the fully retrospective approach is the need to avoid the hindsight with historic determinations. So moving on then to reinsurance. Thanks, Niall. So the first point here is kind of, I suppose, related to the idea that many insurers maybe had planned to amend existing reinsurance treaties to align to quarterly valuations to avoid the need to protect new business over the PNOC period. I suppose this is a likely activity that might have been put on the long finger and practically now needs to be put in place. So there may need to be an engagement with reinsurers. And related then, I suppose, to on point 2, related to the fact that there's increased granularity of management information now coming through. There may be newly discovered pockets of perhaps onerous business. And I guess sort of just a general kind of open question is kind of how will these be managed? Could there be instances where prior reporting masks some of the financials? And I guess there's a kind of an open question as to how companies and their management teams will react to this new information. Moving on then to loss recovery components. I actually spoke to somebody during the week on an international IFRS 17 program, and they mentioned they'd let everything related to loss recovery components until the very end, which was an interesting comment. So for fully retrospective approaches, the applications at transition, companies will need to ensure that their loss recovery component solutions are working appropriately in line with the standard. And a consideration of note here for companies is whether they opt to reflect only the cash flows that relate to the reinsurance risk transferred, rather than using a proportionate approach. Finally, then, a more general challenge for companies as they engage with their external auditors is having their impracticability rationale challenged. And I suppose in some cases, this may lead to additional data, particularly additional model runs being required to extend out the retrospective period. So I appreciate that was a very quick journey through the valuation and reinsurance. I'll now hand over to David to speak about the three topics of contract boundaries and expenses.
Thanks very much, Frank. So hello everybody. I'm David. Frank, you can hear me well. You can.
I can indeed.
Good. Thanks very much. Thanks. I'm David McCurtain, everybody. So I'm going to continue on from what Frank was saying there, and it's a whistle-stop tour where we're actually quite tight on time, where we're wedging in an awful lot of stuff. So I'm going to touch on points here for contract boundaries where market practice is sort of continuing to evolve. That's the theme. The first aspect I'd highlight is just in the slide there. It's how very judgmental contract boundaries are in the IFRS 17 reckoning. And for sure, you need to look at the rights and obligations in the contract, then also your reinsurance contracts. Then you're looking at wider expectations as well, for sure, so regulatory expectations and so on. And that's something I can come back to later in the Q&A if time allows, but I just want to keep moving. One interesting example of that, of the judgments involved, come when you're for unit-linked regular premium business, when you start comparing to Solvency II, where typically you'd have sort of a short contract boundary on Solvency II because you can't compel the customer to pay the premium. But under IFRS 17, depending on various factors and so on, there is a potential for longer contract boundaries, and that raises a whole host of considerations. So you're thinking, will the premiums be paid? Will they be popped? Will there be regular premium increments, single premium top-ups, and so on? And you need a robust, and if you're looking at that, then you need a well-grounded assumption. You need to allow for these things in the valuation. Implications, if you do have that long contract boundary with the future premiums in there and the cash flows arising from that, well, then that's the CSM, the CSM will capture those. And then, so that's a very different quantity. It's there for longer. You're thinking of experience variances then. Well, that means they'd be buffering the CSM if they're about future service, and maybe you don't want to be exposed to some of the variability that could come through in the future. And so there are very significant implications on that one. Whilst on unit-linked business, there's one other there's one actually that's causing quite a bit of angst, and that's the unit-linked protection business, which is old-fashioned for sure, but it's where it's that variety of factors interplaying in the contract that then means it's not trivial to manage the contract boundary rules for that type of business, and it's causing quite a bit of effort and concern for some companies who have material blocks of it. Then moving on to the next point on that slide, apology, yeah, thanks, Niall, apologies. I knew that language was going to not go right. But the next bullet I want to talk about is the post-contract boundary expense approach. And so this is for, let's say you've got your short contract boundary, and then what are you going to do for that part of projection after that? And what's the expense approach going to be in there? So for unit-linked single premium for Solvency II, as just the example we're talking about, you'd probably be looking at a short contract boundary, then thinking of maybe a pumped expense assumption for afterwards, maybe something between full and pumped, maybe a glide path getting to the implied efficiency level, something like that. Then if you're for IFRS 17, you have that same range of considerations. And potentially different considerations from Solvency II if you have a different approach, and operationalizing all of that. It's an interesting one thinking of future market convergence. This I think came up when we were talking in the working group last week, that on market convergence, you wonder when that comes in on IFRS 17. But if you think back for Solvency II, or think of the current for Solvency II, in fact, this is something where the market practice is still quite different across different businesses. And it still hasn't gotten to a consistent treatment. And look, that's probably generally okay if it's well-founded, reasonable in the context of the wider facts and circumstances of, of the narrative for a particular business, isn't it? The further point then is, well, sometimes there are times when this whole contract boundaries, a concept can feel a wee bit artificial because, lo and behold, in reality, policyholders keep paying premiums, don't they, after the supposed boundary? And then the question is, how are we going to recognize that, measure it, present those future premiums? Will it be in a new group of contracts? Or will you look to the details, the facts and circumstances applying, and decide to extend the boundary of the current group of contracts and recognize within that? A separate point then is thinking that, again, sort of the reality of the situation is that, we insurers incur, I guess the business model, we incur acquisition costs, not just to get that current premium onto the books and sold, but in expectation of future renewals coming through for sure after the contract boundary. And so in that context, how it's treated in IFRS 17 is an entity is required to recognize an asset for those insurance acquisition cash flows that are paid after the contract boundary. And so, sorry, apologies, I need to say that again. To recognize an asset for those insurance acquisition cash flows that would come, that are paid now, but before each future group of contracts is recognized, is the point, sorry. And then you need to look at that, think about it. You need to test it, that asset, you need to test it for recoverability. If there's an impairment loss, you need to recognize that to P&L. And that's something that people are sort of still working through exactly what they want to do about that one. Now I'm going to move on to the next slide, please, Niall. And the very first point on that then is the BBNI point. It's just one for people to be aware about reinsurance contracts issued. And this is kind of back to the point that Frank referred to a minute ago, where you've got, say, a 3-month notice period on a reinsurance contract. The reinsurer themselves would see that as a 3-month contract boundary, as Frank was saying, and would need to include the cash flows on new policies arising, new policies being sold and ceded to them in that period. And how you're going to do that estimation, I think, is the bit that needs some consideration. PAA, looking at PAA eligibility, so premium allocation approach. Subtlety here, maybe that for some contracts, you might firstly need to look to the contract boundary to determine that coverage period, because the length of that is one of the key determinants for whether business is eligible for PAA or not. The following point there is, it's really simply just flagging that it's something else to be aware of in this context, that EIOPA have issued new guidelines, recently updated the guidelines for unbundling contracts and how to gauge whether there's a discernible effect on the economics of the contract is sort of the key test in that one. But the point here is that it's something else to be bearing in mind when we are looking at getting the overall operational approach settled for contract boundaries, because it's probably the same model, maybe the same models you've opened, and as well kind of the implications for the numbers alongside that, and just getting the whole thing coherent. Practicalities, well, they're always practical operational considerations. Here, I think they're mainly for reporting teams and managing all of the points I mentioned above. But for instance, you'd have perhaps impacts on upstream. So perhaps, for instance, suppliers of data needing to separately isolate single premium regular premium increments increases from the base underlying regular premium. Maybe downstream, you might have users, consumers of the results where a KPI would be quite different, obviously, if contract boundaries are long rather than short. And then just to make apologies, Niall, I'll ask you to nip back if you don't mind. Thanks. Just a sort of a final comment on contract boundaries would be that it's the bit about market convergence, that hasn't come yet on these points. Some using Solvency II, some blending MCV or something else. And just thinking back to the introduction of Solvency II, there was that initial phase post-introduction where there was sort of change of heart, change of interpretations. And one of those key areas was, several years ago, contract boundaries. And quite possibly then that's the outlook again here. It's for IFRS 17 contract boundaries also might be a little bit up in the air for a while to come. And so it's certainly one to watch, I think, going forward. And Niall, thank you very much. You could move on now if you don't mind, please. So this is a completely separate topic. I'm going to talk about expense assumptions and costs data. So I suppose, firstly, a couple of context comments on this one, like totally separate type of topic and considerations. Even like if I felt the last one was, perhaps you could argue it's an artificial lens maybe to look at things through. I mean, this one is really the collision of reality. So cost data, you're paying rent, light and heat and so on, between cost data with how to reflect that into an expense assumption. So why are we talking about this topic? It's obviously expenses are a judgmental area. It's an important one because the business needs to manage its cost base, and you need to think about how that's, as I was saying, reflected into the framework for reporting and the metrics and so on. And for life companies, it's potentially a significant one because it has a long PV because of the capitalization effect. Then for materiality, I suppose that we would have seen this as a material one. Formal materiality seems to still being thought about. It's thought about so far, I think, in a balance sheet context and with a sort of an eye to, or using the leaning on the Solvency II framework. But then it's over the next while, it's going to have to, I suppose, evolve a little from that to allow for the P&L lens as well, and to be operationalized in the IFRS 17 context. And so that overall, those comments I was making there were the context for why expenses are an important one. And I suppose then an interesting part really for IFRS 17, people always say it's the granularity, isn't it? And so just thinking about the granularity of the assumption first and then coming to the data. So you're thinking of the assumption, what level is that at? So you'd certainly be needing that at portfolio level, probably. You know, people might have thought about looking back over time, wondering about different annual cohorts, but it seems that when we look back, that it was more about launching new products or product iterations and versions was what happened over history, rather than, you know, needing a separate expense assumption by underwriting year. Obviously, granularity is an important thing when we're thinking here, because that can be impactful on this CSM, and you'd have seen some back and forth, maybe trying to get that calibration to where you need it to be, what seems reasonable for the business based on some groups going onerous or not, and so on. Particular one on assumption granularity is about LRC versus LIC, so the liability for incurred claims. And just to reflect, or just to really talk about that for a minute, it sort of makes sense in terms of, say, an income protection product, where you can imagine that the reality of the cost of managing the in-claim phase of a policy, and so that's the LIC phase, the incurred claims liability for incurred claims phase in the IFRS 17 lens, that those costs of the in-claim phase are going to be very different to managing the costs of the open policy waiting for pre-claim. Another consideration as well is whether there would be an expert judgment overlay. Some people would have had this for anticipated diseconomies of scale within a portfolio. Thinking of the opposite, I mean, I don't think we heard any comments, or certainly I didn't anyway, sorry, about people allowing for an improvement in efficiency. Like, a couple of conversations on it, but that would be, say, the glide path while a company is growing towards an efficiency level. But that's certainly something that can be considered within the rules, I would think, if you could justify it. In terms of then final observation on the assumption, as I suppose is which we're at now, isn't it? People are looking at all sorts of things, but one would be the retrospective approaches. And for that, thinking about assumptions, well, it's really not viable to redo historic expense investigations. And so you need to find a way of taking a reasonable approach, don't you, on it? Now, so that was what sorry, Niall, do you mind if I thank you? I think Niall is hinting me that I need to keep the clock moving. So that was the granularity of assumptions. And I'm just going to spend a minute talking about the granularity of data. Because after I want to spend a little bit of time on this first part, because afterwards the remaining points are they're very concise, just the small items to bear in mind. Because here the granularity of cost data then, and when I say costs, I mean money out the door. Trying to map those costs to IFRS 17 reporting granularity needs a fair bit of attention, because you're mapping to groups of contracts, mapping to LIC, LRC. There's data and detail needed. You're talking about systems, data warehouse, and so on. And why I'm saying that is then you've got that practical aspect of trying to defend your outcome at audit or review, whoever it is, because you then need more, I think, because there's so much complexity in data, you need more of a process and control mentality, rather than historically expense assumption tend to be a sort of a single deep dive, you know, a kind of a single complex, a little project you do sort of once off. And so if we're in a process and control mentality in this, then it becomes super important to have comparable and consistent approaches over time, you know, credible, robust data and all that sort of thing. Also on the granularity bit, the classification of insurance and investment business, as Frank was saying, will have perhaps have changed. And so then your cost-based perimeter that you're using needs a bit of attention, and whether you can even distinguish some of those if they're the same teams doing different activities, you need a bit of care there. Obviously, materiality is important as well on that. Going forward for BAU, you need to capture some data perhaps to be able to talk or be able to, say comfortably what's a retrospective effect, or what experience variance is actually looking at more unlocking the CSM for future service. And so there's quite a bit of detail in all of that. And a couple of people actually felt that having to do all of that kind of improved their understanding of the cost base. And I suppose that has to be one good effect from it all anyway. Very final point on that slide then is just that some people in transition had found that they needed to look closely at historic reserves going back a while to see were the manual reserve, manual out of model reserves, to see whether those had been set up more to capture income or cost items, just because they needed to allow for that. Now, Niall, I'll just move on to the next slide briefly, if you don't mind. Attributability, a lot of judgmental areas in this, what's attributable, what's not. It'll vary with company by materiality. So things like how you treat overheads, investment costs, splitting functions, and so on, all needs consideration. Can come back to that if you want. Expense inflation and projection. Interesting point here, it's still evolving. I don't think people have settled on whether, for the GMM model, whether expense inflation is a market data item or is it a non-economic, more like a demographic assumption. And there, the implication then is whether it would be a locked-in rate or not for the GMM. And practice is different here. Some companies see it as a, it's part of the internal competence to decide what the appropriate expense assumption is. Some use a market index, just a transparent objective. There's a mix as well. I think somebody was using maybe applying a market index to a service company. Maybe that was based on that there was a clear contract in place, perhaps. And whereas other than that same business was using that for a Servco, but other costs were just taken to be a general assumption, expense inflation assumption. On projection method, I haven't heard anything particularly interesting to comment on there, very similar to Solvency II. Niall, next slide, please. Thank you. The risk adjustment methodology here, and this is only for expenses risk adjustment I'm talking about, it generally seems to be based on Solvency II, so it's some sort of adaptation, but you'd need to sort of decide your stress level and decide that you can justify it, particularly in the current environment. You think it's valid. Then you'd operationally just recall you need to give a bit of attention to the perimeter of the IFRS 17 insurance business and whether that is the same perimeter of the Solvency II business that you'd be using maybe to generate the stresses, or if you're doing a calibration. I mean, that's an important point as well. If you're in a sort of internal model or own view of capital and that calibration as well as the operational calc step needs to be done carefully. Then again, the point I made about stressing manual reserves or about manual reserves for expenses being in existence, and here there'd be a point as well about having to stress those for risk adjustment. Obviously, that would be if there were substantial items. So a couple of miscellaneous considerations here, while I sort of tell Porrick I'll be momentarily handing over the baton, but a quick thought firstly on that tension, those competing incentives in setting assumptions. For non-life short tail business, I heard a comment that some management preferred to allocate more cost towards the insurance business so as to reduce general operating expenses in P&L. That was the key KPI there. Whereas, the cynic might think that the opposite, in fact, holds on Lifeco, where more of the cost is being shoved towards potentially shoved towards away from more of the cost is being kept away potentially from the insurance business, because that gets the capitalization effect in life insurance. And so that's, you always have those sort of incentives to be aware of, I think. Then final question for us really when we were thinking is, so will IFRS 17 itself cause higher costs? So I've talked a lot about granularity, about effort and so on. And it's reasonable to speculate about whether all this extra work might cause extra effort and higher costs. However, you think those would probably net off against efficiency with overlaps of Solvency II, automation, things like that. And I think people are yet to land on that. We're just sort of awaiting the end of project BAU steady state, whenever that comes. And on that, I will formally hand the baton to Porrick. So thank you very much. Thanks, Porrick.
Thanks for that, David. Plenty to go on there. My name is Porrick, and I'm going to touch very briefly on discount rates in the following few slides. First, maybe just a little bit of background. Unlike Solvency II, IFRS 17 does not specify the discount rates that we are to use. Rather, it broadly sets out two main requirements that are to be met. We are to be market consistent, so whenever possible, derive discount rates using observable market inputs, and discount rates should reflect the characteristics of the underlying liabilities, be that their currency, their timing, or possibly more problematically, their liquidity. The standard does specify two approaches that could be taken in deriving discount rates, which I've set out at the bottom of this slide in the now very well-worn graphic that many of us have probably seen already. The top-down approach starts with the total yield on a reference portfolio and deducts an amount for credit risk and mismatch risk, such that we're matching the characteristics of liabilities rather than assets themselves. And the bottom-up approach starts with the risk-free curve and adds a liquidity premium, with both approaches aiming to settle on a rate that meets both of the criteria that I just went through on the standard. Onto the following slide, we can see some of the issues faced using either approach. On the bottom-up approach, in the first instance, there's a need to start with a risk-free curve. There's an obvious parallel here with Solvency II again, but this is not necessarily a perfect fit for IFRS 17. A clear issue to think about is the impact of the UFR. Other sources that could be considered include government bonds, interbank swap rates, or even perhaps very highly rated corporate debt. Adjustments are likely to be required on the curve, regardless of the choice to begin with, in particular for credit risk, and this might be more sizable if we're using a slightly riskier starting point. Regarding the liquidity premium, that's likely to be a particular challenge in the bottom-up method. There are obvious parallels again to be drawn from Solvency II with the volatility adjustment and the matching adjustment, although in reality these are effectively illiquidity premiums for asset portfolios that have been simply transferred onto specific liabilities. And in truth, they probably only detracted from the last real industry-wide effort to explore a true liability illiquidity premium that was introduced as part of Quiz 5. There's possibly a variety of methods could be used in setting a liquidity premium, but in general, one would expect that arguments about its size are likely to hinge on how predictable the cash flows of the underlying liabilities are, and therefore there's a little bit more reaching back in time. Some similar decisions need to be made using the top-down approach, with a view to be taken on whether to use yields on a reference portfolio of assets or the actual portfolio of assets that's held as a starting point. Either way, on the surface of it, it would seem a little bit more straightforward and perhaps a little bit more aligned to how current IFRS 4 discount rates are derived. However, it's unlikely that flat rates will really be suitable or acceptable for IFRS 17 discounting. So there are likely going to be some complications in terms of converting flat rates into a term structure and a yield curve. Following in from this, there needs to be a consideration of credit risk, perhaps both expected and unexpected losses due to default. And finally, IFRS 17 does require us to reflect the characteristics of liabilities, not assets. So the top-down method will require us to adjust for any mismatches. So perhaps certainly considerations on duration mismatches, and perhaps even for more complex products, higher order aspects such as convexity need to be taken into account. So lots of issues to consider on the technical or operational issues on transition and beyond. And given that we're looking deep into the past for IFRS 17 and locking in rates for the future, not just for the major hurdle of preparing for transition, much like new puppies, IFRS 17 discount rates are not just for Christmas, they're certainly here for life. On to the next slide, I've noted a few additional points worth bearing in mind, a few headings that I've put down here. There's possibly a session by and of itself to talk about some of these items, so I might just whistle through them as quick as I can. And the first point, much like the graphic we had just a moment ago, anytime I've ever come across the comparison of the top-down and the bottom-up methods, it is at least graphically presented as if both methods will converge on some kind of theoretically true single IFRS 17 discount rate. But in practice, this is very unlikely to be the case. There's so many choices to be made from both sides that one is very much likely to have very different outcomes based on top-down or bottom-up. So some very initial thinking to be done on that front. Further concern of transition will obviously be the presentation of the opening balance sheet. Choice of discount rates will affect quite a few items, fulfillment cash flows, CSM, any loss components, and so on and so forth. So initial presentation of the balance sheet might look very different using different approaches. For many Irish entities, there might be some group views to be taken into account here, in particular how group would like to view various different subsidiary results and how various subsidiaries consolidate up to the group picture. In particular, noting that groups might have a particular target in terms of balance sheet equity, CSM held for releases into future profits, and so on and so forth. On the emergence of profit, it should probably be borne in mind that before any complexity is taken into account, the total P&L over the lifetime of the business will be the same, really, regardless of choice of discount rate or, in fact, the choice of basis. But quite often, like all good comedy, timing is everything. And the timescales in many people's mindsets would be far shorter than the lifetimes of many life insurance products that are held on balance sheets right now. So again, it's worth bearing this in mind in terms of transition. It's not just about getting to the transition balance sheet, it's also about how it's going to evolve into the future. So aiming for discount rates that yield a higher opening CSM, for instance, will likely lead to a higher insurance service result into the future, but that could be counteracted with a knock-on impact to the net financial result as liabilities are unwound at a higher discount rate. So lots of considerations to be taken into account there in terms of the likely preferred timing of future profits following transition. Final point I've noted here is the impact of volatility. That there's simply no avoidance of volatility, as we've all seen quite recently. Firstly, and possibly linked to the point above, the choice of discount rate will affect the choice of the opening CSM as well. And the size of the opening CSM will have an impact on the probability of a cohort becoming onerous into the future, which in turn will impact the volatility of any changes to underlying demographic assumptions. So a higher CSM might provide less chance of the CSM becoming wiped out, and therefore impact the volatility of future assumption changes that may result. Secondly, we've seen certainly recently many major central banks seem to be in a race with one another to raise rates as quickly as possible. So we're all possibly reaping the benefits of robust ALM frameworks where we can see both sides of the balance sheet moving together. That's again is something that needs to be borne in mind in terms of the choice of methodology on transition and thereafter. If, for instance, we're using portfolios of reference assets rather than those that are actually held on the balance sheet, there might be volatility in results off into the future. Final point that sprung to mind, possibly a more slightly nuanced version of future volatility, is how interest rates might behave over the course of the formation of a cohort. So, for instance, if we're at the start of the year forming a cohort over the calendar year, are we going to see a lot of volatility in our chosen methodology? Are we going to see what we believed our discount rate was going to be locked in with at Q1 changing quite significantly over Q2, 3, and 4? So there's a little bit to be borne in mind there. When it comes down to volatility, I think we are certainly stuck with it. The spreads either in the assets that are used for the top-down methodology or those used to build up from the bottom-up methodology are something worth bearing in mind in terms of the chosen methodology at transition. That was about all I was going to cover on discount rates, so I might just hand over to Andy.
Great, thanks, Padraig. And hi, folks. So my name is Andy Smith from UI's non-life actuarial practice in Ireland, and I'm going to speak a little bit more with a non-life lens, and in particular, touch on the premium allocation approach and some of the considerations that we see here. So, to recap a little bit and the scene around transition approaches, so as we know, there's the retrospective approach that can be used versus the MRA, and then finally fair value. Now, looking back at the SAI survey that was performed at the end of 2021, we saw that the F4A was being used for almost all, so 95 to 100% of the business. And then that the potential challenges are so onerous contract testing, the allocation of attributable acquisition expenses, and then finally the whole piece around the risk adjustment. Now, as we think about the PA eligibility assessment, then so what we're seeing is some companies performing a refresh there, in particular where they're allowing for things like business changes and whether they may or may not merit a refresh to some degree of the PA eligibility assessment. To recap there on the methodology, so as we know, it involves a comparison. So contracts of one year or less are automatically eligible. Then there's the comparison of the PAA liability for remaining coverage versus that arrived at by the general measurement model. So for groups that contain contracts with a coverage period of more than 1 year, so companies may use the PAA if it reasonably expects that the PAA measurement of the LF4C for the group would not differ materially from the one that would be produced applying the requirements of the building block approach. Now, there's a piece there around terminology and interpretation. So in particular, the reasonably expects or different materially aspects. So there's a question around how are materiality thresholds being defined within the business. There's also the question around how the policy for refresh is defined, and as part of that, the frequency of a reassessment and the extent to which that reassessment is qualitative versus quantitative, or a combination of the two. Other pieces to bear in mind are the assessment of coverage periods and the composition of the business and how they might have changed. And then all in the context as well, of course, of looking at things on an assumed basis, but also considering the seeded PA eligibility assessment as well, as part of that. So if we move on to the next slide, then what I'll touch on firstly is the liability for incurred claims, so the earned provision, and then come on to the next slide to touch on the LFRC. So on the liability for incurred claims and how you get comfort around that, the first piece is that whole control around reconciling the starting points. So what are you using as the jumping off point for your IFRS liability for incurred claims? Is it IFRS 4 or local GAAP reserves, or is the Solvency II, say, claims provision being used as a starting point for that walk? And then if it's the IFRS 4 or local GAAP reserves that are being used, are there any adjustments required to those base numbers? So for example, where you might remove some form of margin to get to a best estimate starting point for Solvency II, are you going to do the same for IFRS 17 then as well? So those adjustments required at the outset being a piece there. I see, Maz, you have a hand up. I'm not sure if that's intended. Okay, sorry, go ahead.
I have to unmute first, but no, that wasn't intended. Sorry, I clicked something.
Okay, so and then thinking about the new IFRS 17 assumptions as part of the liability for incurred claims. So as we know, there's the risk adjustment assumption, which along with discounting is completely new, but there's also the claims handling assumption and the consideration of how does your existing claims handling assumption or provision compare to that being used for IFRS 17. So that comparison being an important consideration as well. Some of the other challenging areas that we've seen for consideration are companies grappling with things like the definition of actual versus accruals, things like interest on funds withheld, reinstatement premiums, and then adverse development covers and the like. So for example, performing the PA eligibility assessment around those and challenges involved there. So then I'll move on to the next slide and touch on the earn provision, so the liability for remaining coverage and some of the challenges and considerations that we've seen around that. So the first piece again is your IFRS 17 provision and looking at that versus the IFRS 4 or local GAAP balances as a starting point, and are they there in terms of a received versus a receivable basis? So depending on the data that might be available, might determine that. And then we come on to look at your deferred acquisition costs. There's a question of how should companies be refining these to meet IFRS 17 requirements? So for example, how are you adjusting that provision to just include those attributable amounts, and then also the related amortization as well to be performed? So there's the point around classification and what is considered acquisition costs under IFRS 17, and then the expenses as well. So the amortization of those attributable expenses. In terms of the UPR and premium receivables then, so there's adjusting for those premium related commissions, and in particular the shift between DAC and UPR. So for example, splitting out between your acquisition aspect coming off DAC versus your non-acquisition components coming off premium, again is a challenge and a consideration as companies work through the LFRC calculation. Reinstatement premiums as well, and making sure to remove those is another component there. Then looking at the DAC payable, and as an equation being the DAC at inception less the DAC paid, there's a question of, are those easily attainable balances? They very well may not be, and so then it might be a question of coming up with a reasonable methodology around that, where those aren't easily attainable. The final piece that I'll touch on in terms of the liability for remaining coverage then is the loss component and the onerous contract test as part of that. So we saw that was one of the key challenging areas that companies were grappling with. So for example, is it being performed at a point in time, or are you going right back? So are the assumptions at the transition date or at the point of inception? So for opening balance sheet purposes, of course, companies are looking at the onerous contract test for contracts as a Q4 2021, and considerations there being around the cash flow basis and challenges around that. So looking at earned versus paid and arriving at the value split by those two bases, and then considering things like your risk adjustment. So you might be going PAA, but what about the risk adjustment allowance within the loss component? So you might have for example, a risk adjustment percentage that you would use for your liability for incurred claims, but is that being perhaps upticked a little bit in terms of an extra loading on top, or some sort of increase to allow for additional uncertainty that may be associated with those unexpired exposures that are forming part of the loss component calculation. Coming in which are 17 are being grappled with. So both profitable and you bring in profitable and unprofitable contracts, versus IFRS 17, where only those onerous or unprofitable contracts are being brought in. And then, as I say, there's that piece around initial recognition and unwinding. Is that the approach, or is there a measurement being perfect? Are some of the key challenges around the LFRC? And with that, now I'll hand over to Maz.
Hello. Hello.
Hi, Maz. Yeah, we can hear you.
Yeah, you can hear me. All good.
No, keep going.
Yeah. Okay. All right. So, So if it's all good, then I'll just start kick off. I was having some trouble with my Wi-Fi at the wrong time, actually. Okay. So I think thanks, Andy. We are at 13:20. Okay. So yeah. So I think, like, with regards to measurement models, I guess it's probably fair to say that everybody has pretty much decided what measurement models they're applying for which portfolios and everything. So all that is done. But one place where you might find like slightly different market practices in terms of end-to-end implementation and what constitutes end-to-end implementation is basically the level of documentation people have done for VFA eligibility assessment. I was actually looking at a paper I looked at a paper a very long time ago from PwC on this subject, but I reopened it for some reason, and it's something like a 15-page paper on how the VFA eligibility assessment should be performed. Okay. Now, what you'll probably see is that within the market is that like there will be some people who would have done very detailed assessments as to what exactly is your variable fee and how you define it, and then performed all the 3 tests for the VFA eligibility assessment. And that is one end of the spectrum. And then the other end of the spectrum is where there isn't where you don't quite have that much documentation or no documentation. So okay. All right. So then on to maybe like the other point I want to pick up is basically regardless of whether the performance tests, one thing which really matters is whether you perform the VFA eligibility test at the date of contract inception, or you perform that at the date of transition. And the answer can change actually, and you might have incentives to do it on one date or the other, depending on whether you want to use VFA or GMM for a product. For example, if you have GAOs on your book, then really you might not want to apply the GMM model to them in the post-annuity phase, sorry, the VFA to them in the post-annuity phase, and therefore you perform the test at transition date. So let's skip on to the next slide then. Okay, so I guess on this one, the main thing I'll cover is, like your measurement models, there are different dates of contract inceptions in case of M&As and, acquisitions that you have over here. So it is possible that, like a different measurement model is applying to a local entity versus the group entity, and then you have intra-group insurance, and as well, where the seeding entity might have a different model and the reinsurer might have a different measurement model. So, like how those things consolidate and eliminate when you're producing your accounts, your consolidated accounts at a group level. So I think that's probably like a few things which people are finding out right now, and still discovering ways to do them more efficiently. Next slide then. So in terms of transition approaches, there are quite a few, like everybody has pretty much an idea of, what they want to do for transition on, what's the FRA, full retrospective cutoff date and all those things. And those decisions involve looking at various things, impact on your opening equity, CSM and transition, etc. I guess like one or two players probably saw that there was some sort of an opportunity to unlock money left in for the distributable reserve actually, So if you take a loss and you have to write down your the non-distributable reserve, you can get money back in form of distributable reserves when subsequently CSM is released. So yeah, I think those are obviously like a few things which people have considered, but then I guess the most important thing and the overriding thing is, what does the standard have to say? I guess that's probably the main thing actually. So if we skip to the next slide actually, Nair. So here you have like a number of factors which companies used for justifying impracticability. I've listed them down, non-exhaustive list. You could have many or different or arguments for FRA assessment, and against each of these there is the risk of hindsight, the cost and effort and everything involved in that. So I guess there's probably one thing I want to pick up on. If you skip on to the next slide actually. So one thing for impracticability is that you cannot apply hindsight in you cannot apply hindsight when you are setting, measuring something retrospectively, and that is something that we all know about. But I guess if I take a 5-10 second break and ask you all to read the right hand part of the slide for one moment and basically see, what does it say actually? How hindsight is defined? Okay. All right. So I guess probably you can have a reread of this, and I will strongly urge you to do so. So if we just jump on to the next slide. So one thing about hindsight is that, if you're making judgments about what management intent would have been in the prior periods, then, that qualifies as hindsight actually. And if you read that in silence, then that is a very, very strong thing actually, and it can actually impact quite a lot of things, your past accounting policies and everything, the assumptions that you're setting. So I guess what I'm going to summarize is that the further somebody goes back into the past to apply full retrospective, you have more risk of producing accounting estimates that have hindsight involved in setting judgments and assumptions, and you also are using data which is older and of lesser quality. So it's not always the case that your it is not always the case that your audit, if like a more auditable number is the one which goes much further back. Actually, sometimes it can be more difficult to argue. Sometimes it can actually be more difficult to argue using the full retrospective approach because of the quality of data you have very far back. Okay, so I guess I'll probably jump on to the last section actually. Yeah, and that's now the next slide. Yeah, so lastly, one thing which has impacted a good few things on transition is the taxation of your opening equity restatements. So your tax liabilities, obviously, if you're recognizing a gain or your loss, there are some tax implications of that. The standard thing is that, you can defer your taxes over a period of 5 years. And that is there, but then there are other countries like actually the UK have done quite very active engagement on how those impacts are going to be treated and everything. So I think that is something that is excellent to read if you are consolidating or your tax teams might be interested in. Then there are other implications, like if you take an opening equity hit and you're regenerating the same profits into the future, are you going to be double taxed on that? How do you manage that? You have your sunset clause in some countries as well, which report up to group level, where you cannot carry forward losses more than a certain period of years. So that will result in double taxation of profits effectively if you're not able to recover them. So those are probably like a few things on tax. Then I guess the last question is, the way the IAS 12 defines, once you create a deferred tax asset, you have to recover it against likely profits. So a question you might ask yourself is, is CSM a source of likely profits? Because historically, we only used to consider profits emerging over the next 5 years. Typically, that was the industry practice as a reliable source of future profits or a likely source of future profits. But then could you potentially go longer with a balance of CSM that is reported on the balance sheet, which is supposed to mean your future profits? So yeah, then there are implications for your Solvency II as well, your IFRS 4, DTA, DTL, Solvency II feeds into your Solvency II, DTA and DTL impacts your LEC DT as well. And lastly, there have been like quite a few interesting global developments. Like Ireland has not really done much on this front, but in Canada, the taxman has decided that the taxman has decided that CSM is not a deductible balance for determining a tax liability. They're effectively taxing the CSM as well, even though profits will be earned at a later point in the future. The Germans have decided to stay with their own approach, the current accounting basis for taxation. And then with BEPS 2.0 down the road, which is coming into effect from 2023, there, like companies who have are using the OCI option are effectively are going to companies who use the OCI option and are reporting profits into a group will have an effective tax rate of 12.5 on the OCI profits. But anything that is going through the P&L will actually be taxed at 15%. So there is a lot of interesting stuff going on. So I finished on 1331. Over to the next speaker now.
Hey, thanks, Maz. So yeah, my name is Francis Fury. Can you hear me, Maz or Niall?
Just to check. Perfect.
Yeah, perfect. Thanks, David. Yeah, so I'm going to cover risk adjustment coverage units and CSM today, I think in that order. So I'll try allocate about 5 minutes each for them. So I'll try stick on time because I recognize we're probably a couple of minutes behind. so there's no reading time for the audience like Maz's. So the risk adjustment is the first topic. I've kind of just laid out what the definition of the risk adjustment is. You know, it's kind of a bit of a fluffy definition, in my opinion. I suppose a definition I've seen recently on the risk adjustment, which I thought was quite nice, is you could say the risk adjustment is maybe interpreted as the probability that the changes in the present value of your future cash flows over a defined horizon will be lower than the risk adjustment at a given constant level. So I think that kind of, to me, that's a bit more clear. So in terms of the approaches used for the calculation of the risk adjustment, these vary across regions. They also vary across the types of companies. For example, cost of capital approach is very popular, obviously for small and medium-sized companies, which again is probably reflective that they're leveraging off their Solvency II standard formula risk margin as opposed to an internal model. The likes of scenario, VAR, and the padded approach are probably the most popular. But it's many kind of UK and European insurers are using that due to the fact that they have internal models already. So they already have their stochastic models in order to calculate. They already have their confidence level, and then they can basically use the scenario VAR, the padded approach. I suppose also the low interest rate environment makes using the cost of capital approach. It leads to fairly a large cost of capital result, which would make it quite unpopular, especially in this interest rate environment. Again, selecting the risk adjustment is more around pragmatism and kind of based on their current reporting process and leveraging off what they have already, rather than getting something that's theoretically ideal. In terms of your target confidence level for the risk adjustment, again, if you're using your VAR approach, your confidence level would have been known from outset. People that are using the cost of capital approach, they need to find a method in order to determine the confidence level over 1 year, and then I guess to transform that into over the longer time horizon. I suppose, yeah, the 1 year confidence level would be higher than a ultimate confidence level over a longer period. And I guess in terms of what's the most popular, there's lots of confidence level out there. As I guess the most popular is hitting around 85%. Also, I've seen companies with quite high confidence levels for their cost of capital approach. And this tended to be kind of because the risk drivers using their cost of capital calculation wasn't running off as quickly as they would in reality. So if the risk drivers, I guess they're leveraging off Solvency II, but if the risk drivers, reflect reality, their confidence level would be a lot lower. In terms of how to allocate the risk adjustment to lower level of granularity, I suppose if people are using the cost of capital, the Solvency II only needs to be measured for each line of business. However, for IFRS 17, it needs to be measured at a group level in order to kind of calculate your CSM and your loss component. I guess those insurers that are using their cost of capital for IFRS 17, they'll need to ensure that the results are produced at the correct level. Insurers that are using the VAR or the padded approach for the risk adjustment, usually they would have their risk adjustment at the right level of granularity in the first place. I guess in terms of what approaches people are using to get it to the right level of granularity, using some kind of pro rata allocation, so such as using like proxy values that might be utilized in your Solvency II risk margin calculation in order to get it to the right level. In terms of determining the risk margin at a 1 year view and an ultimate view, the standard here doesn't provide clear guidance on the guidance, from my opinion anyway. There's kind of a probably desire in the market to do the confidence level over 1 year. However, the IASB is conveying the message that the ultimate runoff time horizon measurement is preferable. I guess if insurers were doing a 1 year runoff, you'd have a 90% confidence level over 1 year. That might equate to kind of a 75% confidence level over a lifetime. That's just as an example. And I suppose one final point on this is, the intention was to increase comparabilities across insurers. And the requirement to disclose on an ultimate basis. However, it kind of dilutes intention, because not only is it complex to calculate and communicate, but also it's hard to get comparability across insurers at an ultimate level, because the runoff insurers, obviously, some companies could run off over 10 years, some over 20 years. So, perhaps a runoff or a time horizon of 5 to 10 years would have been kind of more preferable. In terms of will disclosures be a point estimate or range? Paragraph 119 of the standard states that an entity needs to disclose their confidence level used and determine the risk adjustment for non-financial risk. Insurers are questioning whether this is a point estimate range. However, a range is probably going to be preferred by most clients, because point estimate kind of creates the impression that there's a higher degree of accuracy, and also you don't have it gives you more confidence, and also it gives you you don't want volatility in your results. I have two last points there, but I'm going to move on quite quickly. Differences, comparisons of risk between IFRS 17 risk adjustment and the Solvency II. IFRS 17 is only the insurance lapse and expense risk versus the Solvency II risk adjustment, where it's on all non-hedgeable risks. And I suppose the IFRS 17 risk adjustment can also allow for group diversification. So you could also bring elements of pricing into that, which might reduce your risk adjustment. In terms of the next slide, Niall, please. So the coverage units is the next one. So I have the definition of the coverage units on the slide there. Sorry. Check my time. So the coverage units is on the slide there. I guess the key point around here is the likelihood of insurance events occurring in the period shouldn't dictate the quantity of benefits provided. And IFRS 17 introduced this concept of a stand and ready to provide coverage, and in crude terms, it kind of means, if you had a level term insurance of 100,000, you'd be expected to kind of be using the 100,000 rather than as a coverage unit, rather than using 100,000 multiplied by the probability of that person dying, in crude terms. I suppose a couple of examples of coverage units I'll mention here. So if you had a level term assurance, you might use something like projected total sum assured in force. If you had a immediate index linked annuities, you might have as a coverage unit projected annual annuity in force indexed each year. So you kind of get the gist of it here. If you had a unit-linked savings contract with a sum assured in death and say, for example, 110% of the units in the first 5 years, so you might have a coverage unit, so 110% of the unit fund the first 5 years, and then the unit fund thereafter. Then we have the point around the IFRS developments. I think Niall mentioned it earlier on, and I'm probably not going to go into too much details. But basically, this is about the transfer insurance coverage units under a group of annuity contracts. Again, I think the main thing here is there's two approaches. The IFRS concluded that the approach we consider as the constant annual benefit is consistent with the principle of IFRS 17, whereas the one where the present value of current and future benefits isn't. I'll touch on that in a couple of seconds, actually. And it's probably worth mentioning, this is applicable to all other products like deferred annuities, income protection, pure endowment, etc. I have a couple of, just checking my time there. So methods. So in terms of methods for determining the quantity of benefits related to your insurance coverage, so I've just included a couple of methods here. So you might use a straight line allocation over the passage of time, but also reflecting the number of contracts. You might have a method based on the maximum contractual cover in the period. You also might have something about the amount that the entity expects to pay to policyholder in each period if an insured event occurs. The next one is around possible weightings for, sorry, just take a drink. possible weighting for insurance contracts if there's more than one type of benefit. So for example, if you have two types of benefits and you're trying to get the coverage unit, what kind of weightings you'd use here? Here you might use something like using the amount of the expected outflows for the two different benefits. You might use maybe standalone selling price for the individual services for each of the benefits. Or you might use maybe a combination of time for which the coverage is provided and the maximum amount available to claim. And then other considerations around so reasonable proxies for determining investment return services under a group of insurance contracts. So here, you might use using the amount of assets under management or the amount or that an entity has a right to withdraw. You might use, for example, using the expected investment return to be earned in that particular period, or you might use the stand ready obligation to provide access to them investments or opportunities otherwise not available. It's also worth mentioning, if there's guarantees in these investment return services, they're unlikely to be linear over time, so that also needs to be taken into account. So, they'll come in the money and out the money over time, so that needs to be taken into account. And then finally on this, checking the time, but reason proxies for not allowed for determining coverage units. So I think we mentioned earlier on, coverage units can be based on expected claims or expected cash flows. However, unless you can clearly demonstrate that it is a reason proxy for the service provided under a group of insurance contracts. But I think if you were to use it, I think you'd probably have a battle on your hand with auditors. So if you can go to the next slide, Niall, please. Sorry, just checking the time there. So the last one is around the CSM. Again, there's a definition on the slides there. So the CSM is probably one of the key components of IFRS 17, and it kind of, it'll release a profit or loss over time. We'll be sniffing and showing how the company is going to, how the insurance company is going to perform over time. I've mentioned a couple of things here about Niall mentioned at the start about the multi-currency group of insurance contracts. So that's mentioned twice for some reason, but yeah, it's quite important actually. So there was a tentative decision issued, I think in June sometime. There was a consultation process to last 60 days. I think the IFRS committee and the staff members issued a paper that they had their meeting, I think on the 13th of September. So this is kind of around how an entity determines if currency risk needs to be considered when determining identifying portfolio of insurance contracts. And reading the paper this morning, actually, one of the main things from it was currency risk needs to be considered when determining your portfolio of insurance contracts. However, it's when you're assessing for the purpose of assessing similar risks. It did make the point that you're not assessing identical risks, you're assessing similar risks, and the point around that is that you could have a number of different cash flows within a contract with different currencies. So that ties back to the point about the similar risk. So I suppose the other point around it is how the accounting policy choice on that. So an entity then needs to develop whether they're going to use a single currency accounting policy choice or a multi-currency accounting policy choice. So I think the main point around that is, so they have to develop the accounting policy choice and determine what the group insurance contracts denominated in a single currency or multiple currency. There's two accounting policies you can apply. In the IFRS paper, they give two examples. And the key point from this is applying the multi-currency policy choice, the entity will take full account for the change in the interest rates that affect the fulfillment cash flows. It'll come through in IAS 21, and there'll be no changes in financial risk for IFRS 17. Whereas if you have a single currency account and policy choice, it comes through the change in the exchange rate comes through via IAS 21 and also via changes in your change in financial risk for IFRS 17. So the point here is, under the two methods, if you have a single policy or multi-currency, your fulfillment cash flows will be the same. However, due to the accounting treatment, the CSM will be different under one approach than the other. And just looking at it, it seems that the multi-currency may reduce volatility in your CSM figures, and that's just from looking at it earlier on today. The other things I've to mention around CSM, CSM is kind of it's indicative of your new business contributions. So you can see if your CSM is increasing, it's obviously sign of new business coming onto the books, and it's more than offsetting the runoffs. Other things around the CSM to consider is volatility around your CSM. So which assets will be back in your CSM liability, and what is the IFRS 17 approach? If, for example, if the fair value comes through the P&L, there's potential to bring, there will be volatility through your finance results under IFRS 17, as the CSM under GMM will be on locked-in rates. Also, you need to consider around ALM and the volatility around the CSM, how you consider that in ALM, and that'll also have a knock-on impact on your Solvency II as well. And then finally, I know I'm going slightly overboard, so the final thing is around the bow wave effect. So I'm not sure, some of you may have heard of this. So basically here, you've a build-up of CSM over time. The liabilities under the VFA, it affects the VFA only, but the liabilities can be measured using your market consistent, using like risk neutral rates. However, insurers expect to earn an interest rate in excess of this over time, and this is called the over return. Because of the way IFRS 17 set up, this over return, what happens is this over return gets built up over time, hence the name bow wave. Also, and isn't properly being unlocked, so you'll have a build up CSM. Also, the TVOG reduced over time, so there's a CSM that needs to be unlocked there as well. So there's a couple of approaches insurers are adopting, and I'm sure there's many others. One of the approaches I've seen was setting up a shadow CSM. So this involves the derivation of a CSM release on the basis of calculated real world rates and comparing to the one you've calculated, and the difference will go straight to P&L. And another one, which is an extension of the one I just mentioned, is using an additional step for the CSM release to show the impact of the over return and the TVOG, and to release that to the P&L. And I think the most popular one is companies are making an adjustment to the coverage units. So for example, around how the discounting is done, or also an explicit adjustment to the coverage units. Probably not going to go into the details on how some of that's working, but broadly that's kind of at a high level. So I think that's me, and I hand over to Andrew, sorry. Thanks.
Thanks, Francis.
Thanks. I can hear you well, and Andrew, yep.
Okay, great. So good afternoon, everyone. So to complete our session for today, I'm going to cover transition disclosures, the role of the reporting actuary in IFRS 17 world, and then do a final wrap up. Given the time, it'll be fairly quick, but we've got more information on the slides. So if we go to the next slide there. So in relation to transition disclosures, you might think that your first external reporting of IFRS 17 is going to be in your 2023 financial statements, so possibly sometime in 2024. However, many insurers are going to need to disclose the impact of IFRS 17 much sooner than that. So for example, if you're a listed company or part of a listed group that reports earnings on a quarterly basis, you'll need to report results on an IFRS 17 basis from Q1 next year. But even before that, insurers are likely to need to give some indication to the market in coming months to avoid any surprises at that first reporting date. As Niall mentioned earlier, there was also a statement published in May this year from the European Securities and Markets Authority, or ESMA, in relation to the transparency of implementation of IFRS 17. And this statement highlighted that companies needed to provide relevant and comparable information in their 2022 financial statements of the expected impact of IFRS 17. So this will really bring forward the timing of IFRS 17 disclosures for some companies. And looking at that statement, you can see there that where the impact is expected to be significant, ESMA expects that insurers would provide information about significant policy choices, for example, such as the discount rate methodology or the level of aggregation or the risk adjustment methodology, and also explain the nature of the impacts on the P&L and balance sheet and how profits are recognised, that impact on the opening equity, and looking at what will change in terms of presentation and disclosures. And if we go to the next slide there, I guess looking out there in the market, has there been any public disclosure of IFRS 17 impacts to date? I think there have been some high-level comments provided by a handful of insurers, but there really hasn't been much public disclosure of meaningful IFRS 17 impacts at this stage. So I think that will be coming later this year. And really, despite the ESMA statement that I mentioned on the previous slide, I think companies probably initially be providing qualitative statements of the impact, and will follow up with quantitative impacts, perhaps into next year. But whether you're providing qualitative or quantitative information, it really needs to be thoroughly reviewed by management and audit before you go publishing it. And then there's also some other reporting considerations. So even if you don't report on an IFRS 17 basis locally, you might think you've escaped the complexity of IFRS 17. However, if you're part of a group that reports on an IFRS 17 basis, you'll be providing information to the group for group reporting and disclosures. It'll mean an additional set of financial accounts information you need to produce. And it might have you thinking whether you should even move to IFRS reporting locally to align with group so that you don't have that extra set of information to produce. And then there's also a link between your IFRS 17 reporting and Solvency II reporting. It was mentioned earlier that you need to report in your Solvency II balance sheet your deferred tax assets. In Q1 2023, this is going to reflect the difference between your financial statements and Solvency II basis. So if you're on a IFRS 17 financial statements basis, that again effectively brings forward your IFRS 17 reporting date somewhat, or at least part of it. And then there's also updates to the national specific templates, the P&L template that high prism rated companies have to complete. And so that'll be updated to take account of IFRS 17. So again, you'll need to look into that for Solvency II purposes. And you might need to, if your IFRS 17 numbers aren't totally locked down, you might need to leverage your IFRS 4 numbers to populate some of those templates. In terms of then the second topic I wanted to cover was that of the reporting actuary under IFRS 17. And actuaries have traditionally been very heavily involved in financial statements reporting, but I think will be even more so now under IFRS 17, given the nature of it. Now, there was an AAE discussion paper from back in 2020 that proposed that a role of a reporting actuary under IFRS 17, and that person would be the actuary that was responsible for preparing and conducting the calculation of the insurance liabilities for your IFRS 17 accounts. And it was also proposed that that person would prepare an internal actuarial report to the board to support the financial statements that, again, it would cover key areas such as methodology, assumptions, data, any key judgments, obviously the results, and then any sensitivities around those, particularly in relation to key judgments and uncertainties. It will also highlight any material risks, limitations, and recommendations. Now, that formal requirement for that role hasn't materialised, so it will be interesting, I think, to see how that develops in practice. I mean, in Ireland, in the past, we had the concept of a reporting actuary, This wasn't always a formal role. Some companies have kept that, some haven't. So I think it'll be interesting to see how that develops under IFRS 17. And if you are involved in IFRS 17 reporting, then you'll be interested to know what actuarial standards and guidance are out there to support you. So some actuarial associations have produced guidance and standards for members on IFRS 17 reporting. And there are some useful resources out there that I've listed on the slide here. For example, there's the ISAP 4, which is a non-binding model standard from the International Actuarial Association that provides some useful information on things actuaries should consider when you're carrying out IFRS 17 reporting. It covers things such as consideration of materiality, proportionality, disclosures, and quite a bit more as well. And then there's various information and educational notes out there from the International Actuarial Association and also the European Actuarial Association. So again, some quite useful information there on how to implement IFRS 17 and various examples there. But really, I think any Irish actuary involved in IFRS 17 reporting needs to consider the requirements of the Society's ASP PA2 in relation to general actuarial practice. So I think that's going to be a key one for Irish actuaries. And if we look then in terms of documenting the work that you're doing under IFRS 17, and we go to say the documenting that in a reporting actuaries report, that's on the next slide there. So there's really a lot to consider here as to what could go in that report. There's there was a discussion paper produced by our working group a year or two ago that considered the sort of topics that might be covered in that report. Some listed on this slide here. And I've included a link on the slide here to that discussion paper that might be of use and give you some more ideas as to things there that you might need to document. And then in terms of a bit of a wrap up now, so I sort of wanted to ask, well, how ready is the industry? I think there's a range of readiness for IFRS 17 reporting from insurers. There's loads of work taking place on finalising opening balance sheets, board and audit engagement, working on quarterly reporting and projections of IFRS 17 numbers. And then, I think there will still be lots of work on systems, processes and governance that will carry forward into 2023 as companies try to move towards their target operating model. And as we saw under Solvency II, there's lots of scope for interpretation and judgment, and market practice will take some time to bed down. So I think we'll see some uncertainty and changes for the first couple of years of IFRS 17 reporting, like we did with Solvency II. So look, conscious of time there, I think we're nearly at the end of our allotted time there. So I might just hand over to Niall now to facilitate Q&A if we have time. So thank you.
Thanks, Andrew. And I think big thanks to all of our speakers in terms of trying to get through what we knew was a lot of content in a tight time frame. But we do have some questions come in. Please keep them coming. If we don't answer them today, we will consider them for future events. So it's very helpful if you can share those questions. Starting with one here that perhaps for David on future premium increases and discretionary as opposed to indexed ones for IFRS 17 contract boundaries. What is your view on allowing for those types of cash flows for fair value calculations?
Yep, for sure. Thank you very much, Niall. When I think of fair value, I always just come back to my time, sort of commercial time, your pricing blocks of business, you may be looking at transactions, and it's all about the arm's length transaction value. And it comes there's, firstly, I would say, definitely you're in a place where there's more scope for argument about the contract boundaries. So you don't need to be constrained by artificial, you're into an economic view, what will really happen. But then it becomes, can I convince somebody, sorry, just to restate the question, maybe it's, can I convince somebody, that somebody out there will pay me for the value in the block of business from future extra premiums being paid. Yeah, that's feeling maybe a little bit tenuous, maybe, but certainly you could have the argument. I mean, it's maybe something that if you were trying to put a range, and these things often come to a range, trying to justify something in a range, maybe it would help push out the range a little bit. You would maybe need to be a couple of, what's the word, kind of second order effects. Maybe you need to think about consistency of your admin allowances within it. And then I suppose just another way of looking at it maybe is that if like that, that's all about the future and what's going to happen. But if you're going to say to me that you can justify that based on evidence you have from your past data, well, you'd be wondering why it's fair value, not retrospective methodology. Like if you've got so much data in the past, but I think really it would all come down to, can you justify that a lot of extra regular premium increments are going to be paid in the future? And yeah, you could try it. I think you need a lot of evidence. Not sure some people have heard too much.
Thank you. I think, yeah, I wasn't sure if this question intended to focus on ad hoc single premiums for unit-linked business as one example. And that's what we would also, I think we've all collectively seen those being added in based on new assumptions potentially for ad hoc top-ups. So if they're if you're putting any assumption for that, it would make sense to feed it through for fair value as well to me. So I take one more question. I'm conscious we've gone a little bit over time. Perhaps for Francis on the disclosure of a confidence level for the risk adjustment and whether that should be on a rundown basis rather than say a 1 year basis, and where does IFRS 17 require an ultimate confidence interval?
Yeah, so I think with the risk adjustment, I think it's kind of silent on whether it should be a 1 year, 5 year, an ultimate runoff. And as I kind of said earlier on, the general word on the street from the IASB is that they're looking for an ultimate runoff. I just had a quick look at the survey that we carried out in November there, and the question was, do we do an ultimate runoff or do we do it over a certain number of years? 13 companies responded, 76% responded they'll do an ultimate runoff, and 24% responded they would do a 1 year runoff. So I think the general consensus in the market that it is around an ultimate. And I guess again it is silent in the standard. But then if you look at the disclosures, particularly CSM, all that, we're talking about ultimate runoff. So you're looking at CSMs into the future. And I suppose the 1 year runoff is the Solvency II calibration. And I guess, IFRS 17 isn't Solvency II. So maybe that's why people are kind of thinking of the 1 year runoff. So hopefully that helps.
Thanks, Francis. And we'll squeeze one last question into Porrick on discount rates. A question here wondering, what approaches have you seen to adjust top-down discount rates for duration mismatches?
A very good question. The simple answer is I haven't seen many on the grounds that we're only at the outset here. So quite happy for any of the more broadly viewed consultancy guys on the panel to jump in. To my mind, though, I think although IFRS 17 doesn't specify any limits or restrictions on the assets that can be used from the top-down approach, if you're really looking at a situation where you believe that there could be a materially large mismatch adjustment, that probably calls more into question whether the assets you're holding are an appropriate starting point. It would probably beg the question as to whether you should use a more identifiable reference portfolio to be your starting point for a top-down approach. If that's the case, you're probably moving away from your actual investment strategy and towards one that is more akin to what's going on in IFRS 17. But as I say, I haven't seen any approach winning out over any other in terms of the marketplace, but happy for any of the guys to jump in on that front.
I think when you read out the reg, in fact, or the standard for it, you emphasized subconsciously even the liquidity of the liabilities. And I think that, so I totally agree with what you said there, that it's as much look at the liability side, and then into the ALM, well, that's starting to be a different question. You're maybe into reference portfolio. I'd agree with what you said.
Very good. Well, I think it's just after a bit after 2 now, so I'd like to thank again, a big thank you to all our speakers, Frank, David, Porrick, Andy, Baz, Francis, and Andrew. I'd also like to thank the other members of our IFRS 17 working groups and especially the team from the Society of Actuaries who make all of this possible, and for everyone joining the webinar today. And with that, the meeting is closed. Thank you.
Thanks, everyone.